Good evening once again. So we welcome to today's class, and we're going to continue from where we stopped. Where we stop is we try to look at the adjustments we made on the adjustments that we made on the financial statement. Adjustments. Okay. So we'll be looking at the adjustment on financial statements. That's the month end and the month end or yearly end adjustment statement. So we have looked at bad debt and doubtful debt, and we have to look at a solution on that. Okay, so let's look at one more. We look at one more, then we move on to the next part. Okay, let's look at one more, then we move on to the next adjustment. Now, for question 2, Umaru Nuru has been in business for 7 years. Umaru Nuru has been in business for several years, doing in the sales of second-hand clothes. So he's into sales of second-hand clothes. During the 3-year ended 31st October 2019, he presented the following information relating to the debtors. So you make information available to us that is related to debtors. He said, okay, debtors, including, so in these debtors, the figure given to us, including bad debt, it includes bad debt, while we now have the figure for bad debt on the second column. Then we have for 2017, 2018, and 2019. So you are required to show the above. We are required to show the above 2019. So I expect to show prepare these three statements as trade accounts. After trade account, we also talk about the bad debts. Then after bad debt, extra so we expect to do the extra of profit or loss account. So now the normally close that financial year end to 31st October 31st October. What is given to us, it's 2017 now. It means the total debtors that we are going to debit to trade receivable account is 4.5 million. It's going to be 4.5 million. That's the amount that we are going to the bad debt. Bad debt is a reduction of trade receivables amount. So whenever one side, the other thing we do is to put it on the right-hand side. So now the trade receivable is 4.5 and it's including the bad debt. And bad debt is not is an amount that is not due to receive. We are not hoping to receive from it due to one or two circumstances, one or two issues that have actually been viewed. So if that's the case, then it can actually go to 1.2 year. The bad debt 1.2 million year will be used to deduct. Will be used to a bad debt rate 1. So you credit your trade receivable with 1.2 and debit your bad debt with 1.2. So after that, you close all your financial statement. So you write off your bad debt to the profit or loss account. Why for your debtors account balance, the amount that they're owing you at the end of the year, you have the figure there. So now this is what I said. The first one is the opening debt is what we have to be 1.2. So 4.5 minus 1.2 will give us 3.3. And this 3.3 is the closing balance, is the amount that our clients are owing us. So, and it will serve as the opening balance for 2018. It serves as the opening balance for 2018. Then we look at your bad debt. If you look at your bad debt for 2000, for the year one, which is 2017, we have the trade receivables. The second leg for the trade for the bad debt. And so we have the bad debt here as the under the credit side for the trade receivables account. And we have it on the debit side. If you want to balance it at the end of the year, you now balance the figure to profit or loss account. You qualify into profit or loss account. So it will not, so it's always waiting up to profit or loss account, not balance carried down at the end of the year. That will be added to the next year. No, it's not done that way. Then the statement of profit or loss extra is showing the bad debt that it will be what? That will be used to reduce our gross profit. A bad debt will be used to reduce our gross profit, So the same scenario also, the same thing also you applied to the year two. Now year 2 here we have 8.75. Now 8,750,000 is the closing balance that we have as regards to. So excuse me. So we have 8,750,000. The that we have. That's the closing balance. Now, if that's the total balance that we have at the end of the year, so what is our the addition of the trade receivables that we have accumulated during year to actual trade receivables for the year to give us the actual trade receivables for the year, and that will give us 8.7. So we have this here. So this is about opening balance. We now have the credit sales for the year is 5,450,000. Closing amount, the closing balance for trade receivables is 8,750,000. 8,750,000 minus the opening figure, which is 3.3, will give us 5,450,000. You give us 5,450,000. Then after that, you now do your bad debt. Your bad debt is 3.85. So you credit your bad debt to your profit or loss account. So you to your account, then you debit your bad debt account with the same amount. Then after that, you cannot do the difference. So the this plus this will give us 8.75. That will give us minus 3.85. That's balance. So 4.9 is the closing balance. It will be the opening balance for the third year, which is year 2019. So after you are done with that, so we need to close up our bad debt. So why we close our bad debt to? We close our bad debt to the profit or loss account. Always remember that. Or under the profit or loss account as 3.385. Can you see the 0.2 of year 1 to year 2? The word is actually meant to show the performance for a particular year. Once the year is over, it will not be carried over to the next year. That's a statement of performance, just to show the performance of the sector or the economy or the company at a particular point in time, So now, after that being said, look at the third year. So let's look at the third year, that's year 2019. The third year also the same principle that we have applied to the year 2, which is what 2018, is what we have to apply to the last one as well. But we have opening balance, and the closing balance to get all the credit sales for the year, So if you mind, give me 7.3. And 7.3 is as a 9, which is the opening balance. We give us 7.3. 7.3 is the credit sales for the year. Then you write off your bad debt. You reduce your trade receivable by your bad debt by putting it into debt account, bad debt account, trade receivables to be 6.3, 3.3, or loss account, profit or loss account. So that's where we have it there. So and it's used to reduce the gross profit. The gross profit. So that's that about that. So you can practice. We have more question 4. So anytime if you practice it and you are not sure, or you can let me know. But if you practice and you want someone to look at what you have done, please send it to me. I will review it and let you know if what you have done is right or inappropriate. To discuss is the prepayments, the Akura and the prepayments. Now, what do you understand by the Akura? Akura is actually a concept in the financial basis that is actually what they give us. Okay. So talking about the Akura payment. So the Akura is actually is a concept given that that we earn it, right? And we also know that we incur we record our revenue when they are earned, when they are received. So in that light, it means that it have originated or presented something what we call the receivables and payables. Because it means if I've earned a revenue while someone is owing me. So how do I treat that? That will receivables. It means that the money I've earned but yet to collect is what is called receivables. So it brought back what's called receivables. Also payable. Payable in the sense that, who am I owing? Expenditure that I've incurred but yet to be paid. Expenditure that have incurred but yet to be paid. It means that what is payable. That amount of money is payable, and that's why. So Akura basis brought about the receivables and the payable in the ledger and the final account. So and we know that whenever we are preparing our statement of profit or loss account, the total expenses and the total income that is related to that period is what we record. So we now have all these prepayments. The payment is about payment made in advance, but or to what to the business. So it's actually a business. Is what prepayment is talking about, the amount that is made in advance. The amount that is made in advance. That's prepayment. Talking about that if out of the total payment made by the business on an item of expenditure, a portion is not for accounting period, the amount is a prepaid amount. Now, if you are preparing your financial statement from from the month of January to December, and you normally pay rent from July to June. So you have your financial statement is from January to December. Your rent is from July to June. So how do you account for the rent? Now, if you look at the rent will cost across two financial periods. Then the one that is meant for the first year is cost across from July to December. So what you're going to have as your rent expense, it will be the amount from July to December. Though you have paid the money in advance, the other difference will be paid into what? Into your payable as an asset that you have paid for it, but you are here to enjoy the service. So it will be recorded under the asset column, asset account, asset class. Okay, so it's the amount that you have paid for the year that's related to the year that you will post under your profit or loss account. But if it's not related to the year and it's an expense or income, it will not be posted to that account. So that's what prepayment is talking about. Payment in advance. Payment in advance for service yet to be enjoyed. Payment in advance for service yet to be enjoyed. So how do we treat these two? Now, accrued is actually being regarded as a liability, current liability, because its settlement is between 12 months after the reporting period. After the reporting period. So income generated by but money not yet received will be recorded in the income statement. It's talking about the income that you have what? That you have generated, that you have earned, but you are yet to receive it, will be recorded as income statement. So that's the way we treat that. That also another way also we treat it is that when you have prepaid in advance, like I explained, you advance, maybe you have for 6 months, you have to prorate it, all divided by 12 times the number of months for that current year that you are preparing. So if that's the case, that's okay. Total amount divided by 12, that will give me cost of each month times the number of months that I've used for the month. I will now multiply it. Then I'll put the figure in my statement of profit or loss account. Now, if there's any difference, or that is what I've not enjoyed, value of what I've paid for, but yet to be enjoyed, will now be posted into our current assets account. And if prepaid, prepaid amount, prepaid amount. So let's look at that. Okay. So let's look at question one. Let's look at question one. Exercise on accrual and prepaid accounting. Exercise on accrual and prepaid accounting. So we have question one says year one. Uche set up in business on 1st January year one. That's when he set up the business. The business has a 31st December year end. Business acquired a telephone system on 1st February. So they purchased a telephone system on 1st of February. But note, telephone charges are paid every 3 months in arrears, and telephone invoice received in year one as follows. So telephone charges are paid every 3 months in arrears, and telephone invoices received in year one as follows. So they normally pay the telephone on in arrears. Arrears means that you have enjoyed the benefit before you pay for it. That is arrears. Arrears is value paid for at the end when the service is being consumed by the by being consumed by the payer, by the client. So that's what we call the workers. Now, for telephone charge, they normally pay on 3 months, and they purchase it in the month of February. So which means February, they use it in February, they use it in March, and they use it in April. So at the end of April, they forward them invoice of 5,000 naira. Can you see that? Invoice of 5,000 naira. Then after that, we now move on to the other one that we have, which is talking about the, okay, we have the invoice of 5,000 naira. Can you see here? So we have that. So after we have that, the next one is not for us to move on to after we pay for April. So we have February, March, April. We now have May, June, July. July, at the end of July, they issued another invoice worth 7,500. Then after that, in October, which is 3 months after, they issued another one in what? Another one which is 8,500. Now, remember, they normally this Uche close his account to 31st December. 31st December. Now, if you look at from October, if you count from October to November down to the December, that will give us 3 years. That is what we call November, December. Then the third year will come up in the month of January, the reporting year. So it means that you have enjoyed the service that you have not paid for 2 months. The November and the December that you have enjoyed, but you have not paid for the service is what we call the accrued expenses. That's what we call the accrued expenses. Okay. Now, so how do you account for this? So you are expected to put it in a in what we call table in an accounting format. So the first one is I'm going to open telephone expense account. Telephone expense account. We receive every information. telephone expense account, we receive every information that we have to that relates to the telephone invoices and payment. Now, year one, in year one, they gave us an invoice of 5,000 using the telephone. Our expenses will be debited because it's increasing. That's so it's going to be debited. The other one that we have also is the after that we have April, we have April, May, June, July. We have July. We have July, and that July is saying that we have 7.5. We pay 7.5. So what do we do on that 7.5? Our bank is credited while our telephone expenses is debited. Then after that, we have also at October, they issue us an invoice of 8.5. Then we credited our bank statement and we are debiting our telephone expenses account. Now, for the last year, we are yet to pay. We have not paid for the telephone that we have enjoyed, the telephone services that we have enjoyed. Then we can now go ahead and do what we call the proration. Now, it's given to us in the question that by January following year, the invoice that will be issued is 9,000. The invoice that will be issued is 9,000. Now, 9,000 divided by 3, which because the 9,000 is as a result of 3-month activity service that have been rendered to Uche. So we say 9,000 divided by 3, and that will give us what? That will give us 3,000. It means that in each month, Uche will incur 3,000. Uche will incur 3,000 cost of telephone. Now, if that's the case, now look at okay, how many months do we have left to go in year one? We have January, we have the November and December. So it's not up to 3. So we now say, okay, if that's the case, we only have 2, then 3,000. The 3,000 times 2 will now give us 6,000. So that 6,000 is the element that belongs to the telephone expenses under year one. Under year one. So you put the 6,000 here. You put the 6,000 here. So now after you have done your year one, the next thing was to now write it off. You normally write off the what? We normally balance the account down to the profit or loss account. That's why we have it there. Profit or loss account. Profit or loss account. Then we have balanced it. We have balanced it. Remember, an expense account does not have opening balance. Okay, we don't have opening balance. So let's move on. So let's move on to the other parts. Now, if you look at the other part as well, year two is not telling us that okay, sorry. Let's look at the accrued account. Accrued accounts. Let's look at the accrued account. Now, if you look at the accrued account that we have here, they balance the amount that we have debited or telephone expense account is 6,000. Then we are closer. It means that what we need to come here and put accrue, yes. We need to come here and put 6,000. We have debited the telephone before, so we are crediting accrued accounts. So we balance the figure together to give us this 6,000. Now, after that, remember that your 6,000 under your accrued basis will be your what? Your opening figure for the next year. It's not written down to profit or loss account. Please do not make the mistake of writing liability and asset to your profit or loss account. No, that's not the way. So once it's been found on accrued account, telephone expenses, we have to be 6,000. So we have that. After that, we have the year two. For the year two, we have our opening balance. Can you see our opening balance is 6,000? How do you get our opening balance? It's for the closing balance from year one. We have that to be 6,000. Then we now move on to the year two. So year two also in month of January, they bought 9,000. But this 9,000 is not for January alone, right? But it have 2 months that belongs to the previous year. It has 2 months that belong to the previous year. So what we need to do is to write off that 6,000. So we transfer the 6,000 from accrual basis to our accrual account down to expense account. So we do the transfer back. So how do you do the transfer? You put telephone expenses reversal. Then you see reversal. You put it under the credit side of the telephone expenses. Then after that, we talked about then after that, we move on to the next one, which is what? The one that was paid in the month of April. We have 9,500. We have the one that was paid in 10,000. We have the one that was paid in 10,000. We have this for bank. That's 10,000 for bank. Okay, bank. So you have credited bank, so you are debiting this one. Then after that, you now ask yourself, what is the amount? If you look at the question here, let me show you the question. Okay, so by October, 31st of October, you have ended. So November, December will be the one to address the shortage. Now, the next invoice for the year three is expected to be 10,500. So yeah, they expect to have 10,500 return. So what you do is that you look at the trade receivables. Where is it? Okay, I'm trying to get it. That's okay, but okay. So where we are also explaining the year two. So we have that reversal. We have explained this is a reversal. So the next one is the closing balance. So this 7,000. How do you arrive at this 7,000? We look at the amount that is given for us is 10,500. So 10,500 minus 3 times 2 will give us 7,000. It means that the element of what we have enjoyed for the year two, for your year to pay is 7,000. Is 7,000. Like if that is the case, you can now come here and put, oh, okay, what call it? That's 7,000. We have 7,000. So we have owing closing balance. Closing balance to be 7,000. Okay. Telephone expenses. So the other left for this 7,000 is telephone expenses. The other left for this 7,000 is telephone expenses. So we have 6,000 plus 7,000 to give us 13,000. 13,000 minus 6 will give us 7,000. And that is why we have 7,000 on this column. So that is that about the accrual. So when you have accrued, you are going to show it in your financial position that year to we are though we have not paid, but this expensive has been incurred. You have to show it. Then if you have paid, then you can now move ahead and say, okay, fine, that was the board, that was bank error, that was bank time. They should adjust it. Okay. So now after that being said, so let's look into question two. Let's look into question two. Now, what do you understand by question two? Question two, year one, Moses set up in business on Moses set up in business. Moses set up a business on January 1st of January year one, preparing financial statement to 31st December each year. On 1st March, he obtains annual insurance on his office on the office building, starting from 1st March at cost of 24,000 naira, payable annually in advance. So this one is an advance payment. So open annually in an advance. Okay. So what are we expected to do? Okay, year two, calculate the prepayment amount and show the accounting entries. So we have to calculate the prepayment amount and show the accounting entries. So if that's the case, you look at the set up in business in year one, preparing financial statement to 31st each year. So we identified that this we are going to be the financial period is from January to December. Okay, so let's move on with that. So the other one that we have is on 1st March. He obtained annual insurance on his building, starting from 1st March at cost of 24 naira. Okay, at 4 naira payable annually. So now you want to do this one now, you go just open your insurance account. How much was paid? The actual one that was paid is 24,000. So your bank was reduced by 24,000 after that. But remember, how many that 24,000 is for a full year. That 24,000 is for a full year, but the payment was made in 1st of March. 1st of March. So how many years? That's, insurance is always annual. It's always 12 months, 12 months. So any points you pay, after 12 months, we need to clock 1 year. So now, if that's the case that they actually release out the 24,000, they pay 24,000 naira for the annual. So you need to prorate it. You need to prorate in order to know the value or the amount of value that you have not enjoyed or you are yet to benefit from the insurance. So, okay, so we have that here. So we have this to be 24,000 naira, and that is March. So if we count from March, to December, that will give you 10 months. That will give you 10 months. Okay. So if that's the case, then you can now come and say, okay, 24,000. That's 24,000 is the insurance now. 24,000 is the insurance. And how many months do we insure it for? 12 months. How many months is for the year one? It's 10 months. So you now say 24,000 divided by 12 times 10. That will give you the appropriate word, the amount that is equal to the dignity. So the prepayment. So look at the prepayment. Can you see it here? 4,000. That's the payment 4,000. So we look at that 4,000. We talk about the 24,000 divided by. If you look, press the calculator. Let's just press our calculator for us to confirm. We have 24,000 divided by 12. 24,000 divided by 12. That gives us 2,000. 2,000 times 2 months, because so we have enjoyed it for 10 months. Then the March to December is 10 months. So the other month that we have not enjoyed is 2. That is what that we have paid in advance. So if you do that, that will give us 4,000 naira, and that is how we arrive at this 4,000 naira. The other one, okay, so we have the 4,000 naira there. Then go to prepayment account. Look at the prepayment account here. So we have insurance. You have it there. Now, prepayment account is an asset account. Prepayment account is an asset account, and that is why we are having it at this column. So we have 4,000 here. So we now close up the account to be what? To be 4,000. So we close up the account to 4,000. Okay. Now, after that, you now go to year 2. Also, what is saying in year 2? In year 2, it says that in year 2, the annual insurance premium payable on 1st of March is 30,000 naira for the year to 28 for the year to 28 February year 3. Now, this one is talking about that they make another payment in year 2 that will cover us also for the year 2. So we have 13,000 naira. So a month pay is 30,000 naira. So what we do is that we actually we credit bank and we debit this insurance account. But before we go on, before we do that first, we need to ask ourselves, do we have any amount that we have paid for that we have not used, utilized? That is payment. You have any payments? You know, okay, yes, that's true. I have a payment of 4,000 naira. Oh, if that's the case, we need to transfer this 4,000 naira to the expense account, that we add for the year, because we are in year 2 now. The 4,000 naira that we have separated in year 1 will be utilized in year 2. It will be utilized in year 2. So we have to write it up. So we have insurance. So we have the insurance, 4,000 naira. We credit insurance. Then we debit the okay. Then we debit insurance account. Yeah, insurance expense. Then we debit insurance expense. Then after we have done that for the year as well, we need to calculate. And we will pay 30,000 naira. Was that 1,000 naira utilized fully in that year? No, it was not utilized fully in that year. If that's the case, what is the percentage of what was utilized for that year? So we could have taken our calculator and take 30,000 divided by 12. That will give us 2,500. That is on a monthly basis. 2,500 times 2. That's 5,000. That is 5,000. Okay, so that we arrive at about 5,000. We have a 5,000 here. Can you see that? We have 5,000 here. Then we now come down here and put, okay. And this is for this 5,000. Can you see this 5,000? So you can easily close up this one now. So 4 plus 5 is 9. Why the 9 minus 4 here? The one I've printed the yellow is 5. And that is what we call the closing balance, they go closing balance. Then we also close our profit or loss account as well. So we write it what we go down to profit or loss account. So in that income or revenue, I always say towards the profit or loss account is equal to bottom profit or loss account. So that is that about that. Okay, I think that's all for that. So if you have any question, please let me know. Then we have more. Then we have the next topic we'll talk about is IS 16. It's also an adjustment. We have the depreciation, which form an adjustment on the financial statement as well. So we look at the depreciation. Any question on what we have done today? Any question? Any question? Any question so far?
There's no question.
Okay. Okay. In absence of question, in absence of the question. Oh, my speech is not clear. Wow, you should have told me. Is it my speech is not clear or network? Please let me confirm. Is it that my voice is very low or the network? Okay. Hmm. Okay, please send me that.
Seems is your network is breaking.
And please always try, like the rules of the classes. The rules of the classes that students are expected to be mute, both audio and video. Please endeavor to use the chat button. Please endeavor to use the chat button when you want to interact with your lecturer. In Olua, please always do that. Thank you. So in absence of any question, let's move to the next material. Let's move to the next material, which is the adjustment. So let's come in. Come in trying to get the material. Just need some minutes. Okay. Maybe I should log in. Okay. Okay. Let me try. Just give me some minutes. Let me try to log out and log in there. Let's see if that will work out. Let me try to log out and log in. Let me see if that will work.
welcome back to class. Welcome back to class. So I believe I can hear me very well now. Please always use the chat box to respond to this. Can you hear me? Is it clear now? Is it better now? Please, can you hear me very well? Can you just say yes? You can hear me? Just chat and send me yes, you can hear me. That is clear. I want to know which one will show. Oh, you can hear me? Wow. Okay. Okay. Just give me 1 minute. Just give me 1 minute, please. I'm talking.
Now, today, what we want to talk about now is the continuation of where we stopped. Is actually adjustment of final account, like I said. Now we are talking about the non-current asset. Now we want to talk about the non-current asset and depreciation. And there is a standard that regulates how these things are being done. That's IAS 16. So it's one that talks about the non-current asset. How do we call non-current assets? So basically, non-current assets are assets that will be useful for more than 1 year. They are often referred to as long-term or long-life assets. Okay, so non-current assets, they include what we know as the plant, the property, equipment. That's what we call the short, PPE. That's property, plant, and equipment item used to conduct operation. These are the items. These are the assets that is used to conduct the operation of the business. To conduct the operation of the business. So we have PPE. So, but that's the full meaning of PPE is property, plant, and equipment. Okay. Now, what are the examples of PPE that we have? We have the land, we have the buildings, we have the equipment, we have the motor vehicles, we have furniture and fittings, we have machines. What are the examples of PPE? And they are known as what? As the non-current asset. Non-current asset. So initially, before we move on into this, that we have to understand that IAS 16 talks about how accounts are being recorded, how non-current assets are recorded in the financial statement. Now, whenever you're talking about recording of information or transaction on the financial statement, you need number one is the recognition. Now, you need to tell if that a transaction falls in line with the asset before you can recognize it as an asset. And what are the things that you test before you recognize any transaction as an asset? Number one, the transaction must fulfill the the definition of an asset. The definition of an asset must be in line with accordance with the transaction. Number two, they measure the amount of the item of the asset must be must be measurable. It must be measurable. Ability to attach a figure to it is actually another important factor that is being considered. Then also, we now talk about measurements. For all standard, we have three types of measurements. We have three types of measurement. We have the initial measurement, we have the subsequent measurement, and we have the recognition measurement. The types of measurement we have. The first one is initial measurement. The second one is the subsequent measurement. The third one is the recognition measurement. Now, from the word themselves, you will be able to pick one or two things out from it. Now, what is the initial measurement? Initial measurement is the amount that is used to value the asset when it's just introduced into the business. When you just introduce an asset into the business, what we do is what we call initial measurement. Now, once you introduce it, there's an adjustment that being carried out on the asset year in, year out. Those adjustments is what we call subsequent measurement. Subsequent measurement. Then when you talk about that, okay, the asset is no longer available, is no longer useful for you, you want to dispose it, or the asset, you want to sell off the asset because you want to buy another new and latest technology in town. So you let it go. That's what we call the recognition measurement. It means that you have to recognize the existence of the asset in your financial statement. So these are the three measurements that you have in standard, and you need to know them in order for you to know appropriate way to measure every item or every element in the financial statement. Now, the initial measurement. Initial measurement is talking about the property, plant, and equipment are initially recorded in the account of the business at their cost. So whenever you want to record the PPE, the PPE are initially recorded at their cost. And what is the cost? Their cost consists of what we call the purchase price, or another name for the purchase price is the listed price. Another name for it is the quoted price. Now, the purchase price less trade discount, that if there's any, less trade discount, and from there, you now add all relevant costs, all direct attributable costs, all relevant and direct attributable costs will now be added to it to give you the total cost that you are going to use to. That is initial measurement. For example, I purchase calculator from overseas. I purchase calculator from overseas. Now, after I've received it, I will now look at what is the price, or I'm going to use to record that calculator in my financial statement. It means that I will need to calculate. I will need to calculate the first one. I'm going to need to calculate the total cost that have incurred, the purchase cost, number one. Number two, if there's any trade discount, I will less it from the purchase cost. Number three is any other cost that I have incurred to transport the material, to transport the calculator from the point of purchase down to my warehouse in Nigeria are being regarded as a direct attributable cost, because they are directly linked to the purchase of the have in our material. Now, looking at this, we have this to be these direct attributable costs. So we listed some of them. And number one, employee costs. Employee costs. Yeah, we have that. So this directly attributable costs may include. Example of what the directly attributable costs may include is number one, employee costs arising directly from the installation or construction of the asset. Number two, the cost of site preparation. That's another cost function. Number three is delivery cost. That's the carriage inward, the cost that you use to take it from the port down to your warehouse, or from your point of purchase down to your warehouse. Another one we have is testing cost. Testing cost. If you purchase a machine and it's not fit and you are testing it, those are the testing costs. You have to add them together. Another one we have is installation and assembly costs. So any cost that you incur to install it and to assemble it is known as what? Installation and relevant. They are part of what makes up the cost of the professional fee directly attributable to the purchase. Professional fee directly attributable to the purchase. So the more you solve the question, the more you get related to every other cost. The more you solve, the more you get to know the other costs that are direct. Now, after that being said, let's look at an example. Then from the example, we used to explain how initial measurements are used to record our assets in our financial statement. Now, we have a company has purchased a large item of plants. A company has purchased a large item of plants. The following costs were incurred. So they incur the following costs. What are the costs they incur? Listed price. Listed price of the machine is 1 million. Okay. Trade discount given to company is 50,000. Delivery cost, installation cost, cost of site preparation, architect fees, administration expenses. Now they now ask us to calculate what is the cost of the plants. What is the cost of the plant? The cost of the plant that we are going to use to record the asset of the plant in our financial statement is what we call, no, so we now look at it. We have a list price of the machine. The list price of the machine is 1 million. So we have that 1 million. We now are like, what is the trade discount? The trade discount is 50,000. Then it totally means that it's 1 million minus what? Minus 50,000 will give me purchase price less trade discount. So 1 million minus 50,000, the actual amount paid for the asset is 950,000. Because 1 million minus 50,000 give us 950,000. So the actual amount paid for the plant is 950,000. Then we now look at delivery cost. Delivery cost is attributable cost because without you incurring that delivery cost, the plant will not be available where you want it to be available. Installation cost is also part of it. If you purchase a plant now right now and you didn't install it, it will just be there. It will not render what it is part of attributable cost because the standard says that any asset will be depreciated when they are readily available for use, when the asset is available for use. So we have also, so the delivery cost is the relevant cost. We have the installation cost is also relevant. Cost of site preparation. Now, cost of site preparation, they're not referring to wages of those people inside. They are referring that the cost that an architect have incurred to make sure that the cost of the to make sure that the cost of the site preparation is being accounted for. Then we now have the architect. We have the architect fees. We have the administration expenses. Now, of the architect to what it allows the architect to come on board and perform his function before the landing or the purchase of the plant. So it's also part of this. Then we now have the administrative expenses. Administrative expenses are fixed costs. They are not part of attributable costs. The reason is that either we purchase the plant or not, we incur the same, going to incur the same cost. So administrative expense is seen as it cannot adjust. So now, if you do your computation very well, that should give you the cost of your plant. It means that list price minus 50,000 plus delivery van plus installation van plus cost of site preparation plus architect fees. Then we are not going to touch the administrative expenses because they are like some costs. Either I produce or not, there will also come. There will also change whether we purchase the plant or not. We are going to pay salary. We are going to pay rent. We are going to do overhead. So that's so they are what they are like sunk cost, okay, until the otherwise stated. So if you add everything together, it'll give you 1.39. 1.39. That is what we're going to give it. The other one that we have is accounting treatment. So we have the accounting treatment. So how did you treat them? The accounting treatment is talking about, okay, this entry that we have purchased a plant. So what do we do about the plant? It's very simple. The plant account is an asset account. So and we said that whenever an asset account increases, you debit the account. But whenever it's decreasing, you debit, you credit the account. Now on this note, it will help us to say plant is one we are purchasing plant. It means that the finger in plant will increase. So if it increased, then we are good to go. Now the second one to be under the bank. It will be under the bank. But if you have not paid and you are expecting to, you are planning to pay in the future, it will be posted under the way. It will be put under bank payable. If it's bank, if you are paying bank, it depends on that bank. But if we are not paying in bank, if we are not paying in cash, rather, you want to delay for a later period in time, it will be posted to under order payable. Order payable. Order you need to familiarize yourself with to know the entry. It's actually very important. So now let's look at some things that we call the capitalization and expenditure. That's what we call capital expenditure and revenue expenditure. What is capital expenditure? Capital expenditure are the expenses that are capitalized over its estimated useful life. They are the amount that is the work that is used to work on the asset that is reasonable or material enough to be spread across a few specified numbers of years. So if I carry out a major repair on my vehicle and it costs me like 30 or 40% of my total vehicle, it's more reasonable for me to what? So it's more reasonable for me to capitalize it, because the capitalization is just like spreading the cost over some years. That's what capitalization is talking about. It's about spreading the what information that you expect to spread over a particular period of time. So we have that. Then we now have the repair. Now we have a motor vehicle right now. I purchased a new engine. That in purchase of new engine, the value of the engine is actually what is expected to be capitalized, because it increased the efficiency of the asset. It increased the efficiency of the asset, and at the same time also it helps it increases the durability of it, because people trust it. We're not going to the car will be going fine here, good to go. But we are not going to expense it because it actually was substantial. So what they're going to do is the cost of the engine will be capitalized. You are not going to find the cost of engine on a profit or loss account, but you're going to find under the statement of financial position where you capitalize it. But if you spend money on repairs, maybe like diesel, change of oil, filters, and the rest, those are minor expenses. So you expense them. How do you expense them? So you go to others. If you look at the repairs are expense. Expenditure on a non-current asset after acquisition is treated as revenue expenditure when it is incurred to a major repair. When it is incurred to what? To major repair. Okay. So that is the difference between within the capitalization and an expense, repair expense. So you normally capitalize your reasonable amount, material amount. Okay. Now the other one we want to talk about, okay, so let's look at depreciation and method. Now, what do you understand by depreciation? Depreciation has been divided by ISC to be what? To be systematic of depreciable amount of an item of what? PPE over its estimated useful life. That's depreciation. Depreciation, you can also talk about what? Is systematic allocation. Systematic allocation of the depreciable amount to an item or property, plants and equipment over its estimated useful life. That is the definition. So when you purchase an asset of 20,000 naira and expect to be in use for 20 years, so you have to spread them over the 20 years. That 20,000 naira will be asset will be spread over over the 20 years. And what we are doing is what we are we are planning, or you have accounted for depreciation. So that is that we are on is on a yearly basis. Depreciation also shows the resources, that you have enjoyed from, or the benefits or resources that you have enjoyed from the asset. So that's in form of depreciation. Looking at, okay, what is the value I've actually enjoyed from this, was from doing and carry out our activities and the rest and the other. Okay, so that's what depreciation. So the next one we want to talk about. So let's look at terminologies. So we have terminology. We have number one, we have the depreciable asset. Depreciable asset is an asset that has the following features. Depreciable asset have the following features, because we talk about depreciable amount. What are the depreciable amount? Is the word depreciable asset. What are the features? What are the attributes that you say there before you say, yeah, this one is depreciable? Number one, is useful life or what is always over a year. Its useful life is always over a year. Once it's less than or equal to a year, it means that that amount should be expensed. Another one we have is accrued primarily for the use in production of goods and service. What is the purpose of you buying the asset? Is it for use and service, or is it for party? Okay, that's what you talk about. That okay, acquire primarily for the use in the production of goods and services. Then also has a limited useful life. You must not say that an asset will be in long for a long period of time. It's expected to have a useful life, the maturity period when the asset will reach. And lastly, we have the one that talks about not intended for sales in the original course of business. Now, if you have an asset, asset that is used to generate production and service or product and services, then it means that what you must not have the plan to sell off the asset. That's what it's okay. That's what we call depreciable assets, not included for sales in the cost of asset, not included for sales in the original cost of asset. Now, there are other things that you need to know also. According to depreciation, we have what we call residual value. This is also known as the scrap value. This is the estimated amount recoverable from the disposal of a non-current asset after its expected useful economy life. That's residual value. Residual value is talking about the scrap value. It's talking about the salvage value. It's talking about the value that it has actually is being reduced. If you look at the definition that I've read there, this is the estimated amount recoverable from the disposal of a non-current asset. So when you dispose of the asset, something that's what we call residual value on the asset that was disposed, residual value. So look at, okay, if that's the case, then what is the cost of the asset? If I want to sell it, what is the residual value? Calculate it based on the way you see fit. Then we also have obsolescence. Obsolescence simply means that this factor which renders a non-current asset useless, even though it is still in good physical and working condition. It's about you damaging what you don't need. Looking at, okay, what are the things that I need? I don't need these 5 bags, I don't need these 20 bags or shoes. Then you can take it out. That's because that's obsolescence. It means that it's old. It's no longer invoked again. You have to go for another one. So that is the obsolescence. That's the meaning of that. Then we will now move on to how do we calculate depreciation. We have talked about the theory of depreciation. So how do we calculate depreciation? Now, before we can calculate depreciation, we need to know there are different methods that can be used to calculate depreciation. What are the methods? We have the straight line method, we have the reducing balance method, we have the sum of the year digit method. I think we have other method as well. So these are the major three methods that we're about. Okay, so now let's look at the straight line method. Straight line method actually simple use of the scrap value minus the what? Minus the cost, all divided by useful life, estimated useful life. So we have straight line method there. The other case, so we have the formula say cost minus scrap value, all divided by useful life. Cost minus scrap value, all divided by useful life. That is what? That is the formula for calculating straight line method. Then we now, okay, so let's test it with an example. Example 1, a machine costs 100,000. It has an estimated useful life. It has an estimated useful life of 5 years or 5 days. Its salvage value at the end of the fifth year is estimated to be 10,000 naira. What is the annual depreciation? So that also calculate the annual depreciation. So what we do is that annual depreciation is 100,000. That will give us 100,000 minus 10,000. That will give us 100,000 minus 10,000, all divided by 5. The 5 is what we call the useful life. The 5 is what we call the useful life. So 100,000 minus 10,000 will give us 19,000. 90,000 divided by 5 will give us 18,000. 18,000. 18,000. So we will look out to information 2, talking about reducing balance model. Reducing balance model. Under this model, a percentage is charged on the what? On the written down value of the what? Of the asset annually until it is disposed of. Now, the reducing balance normally use what we call the carrying amount. So they tends to charge the percentage on the amount until the amount runs to zero. On the amount runs to zero. So that is what we call what the reducing balance method. Reducing balance method. So for example, let's look at example 2 to explain that. That's example 2 to explain that. We have a machine cost 100,000 to be depreciated 20 years. Can you see? So they give us the number of years in which the asset will depreciate 20 years. What will be the depreciation expense at the end of third year using regular bus method? So if that's the case, okay, look at, okay, fine. When do we have, what are the information that we have? We have information of 100,000, the initial amount. Then also we have 20% of that. That's 20,000. That's 20,000. So we have that 20,000. And that one also is end of second year. End of second year is about 20% of what? Of 200. Of 200. Then after that, what did we say? Evaluation method. Sorry, before we evaluation method, let us touch on the residual value balance. So we have 20% times 100,000. 20% times 100,000 will give us 20,000 naira. So it means that 20,000 naira is the depreciation for the year. That 20,000 naira is what? Is the depreciation for the year. Then we move on to the next year. That's the year, or second year. Second year will be 20% times the carrying amount. So for us to get the carrying amount, it will be 100,000 minus 20,000, and that will give us 80,000. So 80,000 times the 20% will give us what? 16,000. Now, this 16,000 is actually as a result of the depreciation for the year to second year. Then we move on to the third of the year. That's 20% of 80,000, which is 100 year. With 100 minus 20 give us 80. So we have the what? 80 year minus 16,000, and that will be used for the third year. And overall, it will be 12,800. 12,800. So evaluation method, under this method, the value of the asset at the beginning is being measured compared to the asset portfolio in the year and the closing balance of the asset. So we have the format here. We have value. Firstly comes value of asset at the beginning of the year. Value of asset at the beginning of the year. Then after that, we have add cost of asset. Add what? Add the cost of asset purchased during the year. Now look at, what have I purchased during the year? So I've purchased 20,000 naira worth of items that we have 5,000 naira before. It means that the total worth will be 25,000 naira. So we have that, we have everything together. Then we now move on to what? To the least value of reason. Value of asset at the end of the year. So we have value of asset at the end. So you carry out value of the evaluation at the beginning and also at the end of the year. At the beginning and also at the end of the year. So we have the value valuation. So if you look at the question 3 says, are they had a van worth 20,000 at the beginning of the year. So that is the amount given to them at the beginning of the year, 20,000. During the course of the year, he purchased additional van costing 10,000. So additional van will enter. So we can just put additional there, additional as a column, and put that amount there. Then we move on to the next one that talks about the 20,000. Okay, after the 20,000, during the course of the year, additional van was 10,000. After that, we have added value the total worth of van at the end of the year to be 25,000. Added value the total worth of van at the end of the year to be 25,000. So at the end of the year, you now look at what is the worth of this van altogether. The worth of the van is now 25,000. But remember, in the beginning of the year, the worth of the van was what, 20,000. He added 10,000 during the year, making it 30,000. Now we are not thinking, oh, it should be 30,000, but at the end of the year, you carry out valuation. Now notice that 30,000 now is overstated. It's actually to 25,000. This means that element, the difference element there, is what? It is the revaluation or the depreciation for the year. Can you see using revaluation method? So we have 30,000 minus 25,000 will give us 5,000. 5,000 there is a depreciation for the year. Depreciation for the year. Then after that, what else we have? So we have the accounting treatment. We have the two ways. We have two ways in which we treat depreciation. We have two ways in which we treat depreciation. We have the first one. Okay, so we have the first one is that the machine account will change. The machine account will change. That's the first one. Then we have this. Okay, so the first one is that what the annual depreciation is charged to the machine account. So the figure in the machine account will change over time. So now using example one, the one that we solve using the straight line method. The total cost of the asset was 100,000. So we have put 100,000 here. Can you see this is 100,000? That is the total cost of the asset is 100,000. Then after that, what is the depreciation for the year? The depreciation for the year is 18,000. Is 18,000. It means that the difference between 100,000 here and 18,000 here will be our closing balance, and that is 82,000. Now this figure that we are talking about, we are playing with, they are all okay. This 80,000 is 82,000. We are trying. These are carrying amounts. I think this column here is what is carrying amount. It has carrying amount. So when you deduct your depreciation for the year from the cost of the asset, what you have gotten is carrying amount, the amount that you are going to carry the asset in your financial statement. After you have credited your depreciation to machine account, the other one is now to go to depreciation account and debit them. So that's the first method. The second method now is that if your machine account will remain the same in respect of the changes in the depreciation. Now it means each of us in the first example that we did, we credited the machinery account with depreciation, but this time around we are not going to credit the machinery account with that depreciation. What we are going to do is we are going to credit accumulated depreciation account. So once I'm able to do that, then I know that I'm good to go. So I have my machine cost, my machinery cost to be 100,000. I have my 100,000 here. Then the depreciation for the year, I have that depreciation is an expense account. So I have 18,000 here. Now the second leg will not come to my machinery account. It will come to what we call accumulated depreciation account, accumulated. So because this is the first time that you are going to record this statement, this transaction in my record, then definitely it will have 18,000. So it have a credit balance. So you credit the accumulated depreciation. Then you debit You debit the depreciation account. Please, they are different from each other. Accumulated depreciation is talking about the addition of the previous amount together to get the total amount that you have removed from the cost of asset. That's accumulated depreciation. But anytime you hear the word carrying amount, it means that there's probability that number one, their family is to okay, there's probability. Sorry about that. So anytime you actually, so we have that 18,000, we have 18,000, so we have that. So you write off our depreciation. So let us add up our depreciation. We have our depreciation, we have it to be 18,000. So we close the account for depreciation account. Once we are closing the account for depreciation account, we are writing it off to profit or loss account. We are writing it off to profit or loss account. Then we now what? We balance our accumulated depreciation. Now, this accumulated depreciation will be used to reduce our total cost of the asset on the face of the statement of financial position, on the statement of financial position. So what are you going to see on the statement of the financial position? You're going to see cost 100,000, accumulated depreciation 18,000. Then you now see carrying amount of 82,000. 82,000. These are the two ways in which we record depreciation. So in case you open some textbook and you notice that they record depreciation using method 1, and you open another textbook, they use another what? They use method 2 to record that depreciation. No, does not mean that any of them is wrong. Does not mean that any one of them is wrong. Please and please pay attention. Pay attention to this. Pay attention to this IAS 16. It is probability of it coming out is very, very high. The probability of it coming out is very, 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 very high. Please pay attention to IAS 16. IAS 16 is 80 to 90% that they will test IAS 16. Okay, so now after we have that, you now can I go ahead and do extra or statement of financial position. So we have the machinery 100,000, we have the accumulated distribution 18,000. So the carrying amount is what? Is 82,000, just as explained earlier. Just as explained earlier. So please, our time before spent. Sorry, okay. So I would love to end the class here. I would love to end the class here. So we continue from there in our next class. Thank you so much for your time and your patience about the network. I so much appreciate you. I so much appreciate you. So we can continue from there next class. We can continue from here next class. Thank you so much and do enjoy the rest of the evening.